Hello everyone, I'm Steve Savant, host of the Business Insurance Zone. Today and all this week, I'm going to have as my very special guest, Sheryl Moore, one of the top industry indexed annuity and indexed universal life experts in the country. She's going to introduce some concepts today on caps, spreads, and participation rates. You're going to be going to school, and Sheryl's going to be your drill instructor. So join us here at the Business Insurance Zone for today's special with Sheryl Moore. Brokers Alliance and the National Insurance Clearinghouse present the Business Insurance Zone, a Bravo video event. Broadcasting in HD 1080p on Vimeo, YouTube, the Insurance Newsnet, Agent Navigator, brokersalliance.com, and on Facebook, LinkedIn, Twitter, and the Insurance Forum. And now your host, the whiz of the biz, Steve Savant. Well, welcome everyone to the Business Insurance Zone, the talk show that spotlights insurance in your practice, keeps you up to speed on insurance news and products, features insurance strategies from top advisors. Get in the zone, the Business Insurance Zone. Our email address is thebiz@brokersalliance.com, or you can call us on our toll-free 1-800-290-7226 for any product or question quotes for life insurance, annuity, DI, LTC, and group pension. And remember, I'm not a tax or legal advisor, so before moving forward with anything we talk about on our show, always consult your CPA or your attorney. And if you're a FINRA registered rep, always check in with your compliance department to make sure that everything that they're okay with everything we're saying. And today, my special guest on the show is Sheryl Moore, founder, creator, and really diva of indexing. Welcome to our show, Sheryl Moore.
Thanks so much for having me, Steve.
I want to say this, no one could be more welcome on my show than you.
Oh, thank you.
You are the due diligence daughter of all that I survey, right? I mean, when we talk about, we love vital signs. Mm-hmm. We love CompuLife. I mean, we use a lot of spreadsheeting technology to make sure that our producers and their clients are up to speed on everything we're talking about. But I have to say, your product, life specs and annuity specs, which we're going to get into later on in the week, these are just huge packages that are just so great. If you haven't seen this is the greatest digest. I mean, why sit there and go through a life specimen contract? I mean, talk about mind-numbing. That is mind-numbing, right?
I think it's exciting, actually.
Oh, well, for all of you who are not as anal retentive as we are and is not as analytic, I guess that's okay, right?
Right, exactly.
But what you've done, I mean, I'm looking at this. When I look at these, this is a 5-page report. 5-page report, and I'm looking at this, and I'm looking, everything I need to know about any index life is on this report.
Yeah.
And I like how it's spreadsheet, and according to the software, the way I've been using it, and if I'm doing it wrong, I certainly want to know, I can actually put 4 companies side by side on any one report.
Exactly.
And in my view, if you're using indexing for income, generally, you can look at the top 4 carriers in indexing for income, and those are the players pretty much you're going to be playing with anyways.
Yep.
And then if you need intel on competitors that are not in that top 4, then I suggest making another report for people that you're actually going heads up with. Now, of course, you can use this for indemnification. And a lot of people do use indexing for indemnification scenarios. But either way, this report has everything on it. Now, what I want to do, we're going to be here all week, Monday through Friday, talking about the first 3 days we're going to be doing life specs, and then Thursday, Friday we're going to be doing annuity specs. But what I'm really wanting to get done today is kind of introduce the package. We all think we know what indexing is, but every time I speak publicly, I know you're a huge speaker on the net, publisher, author, you're in tons of web portals. I don't know, my guys I don't think they know what indexing is.
That's interesting that you say that, because I have a ton of people who are actually writing the business right now, but they ask very simplistic questions that you think, boy, you really ought to know that. Indexed life is just traditional universal life with a different way of crediting interest, period. I have a lot of guys who give an objection saying, I know what you're saying about indexed life, but I'm comfortable with my GUL. Mm-hmm. It's no different, but it has a different way of crediting interest. Mm-hmm. Now, you can get index life with a no lapse guarantee on it, just like you can on traditional UL, but most people use it for cash accumulation. Mm-hmm. We are merely earning interest based off the performance of some index or benchmark, like the S&P 500 or the Dow Jones Industrial. The one thing that's different is you are never investing directly in the index. You're merely earning interest off of
No,
the growth.
that's a big point, because I think everybody looks at that as, hey, we're buying the same S&P 500, like the one I was looking at the other night. I was looking at Fidelity, and by the way, you can give me a little commercial time for that. But for Fidelity, I was looking at the M&E charge. If you just bought the index straight out off the market, very low M&E. But that isn't what I'm getting if I get the same product on one of these platforms.
That's right, Steve. And that's because on an index life product, you have a floor. You can never receive less than 0. And some index life products allow you to have as much as 3% guaranteed floor, regardless of what happens in the index. The difference between your fund and the index UL is that when the market goes up 20%, you might get that with your fund, but you're not going to get that with the indexed UL. You might only get 17% of the 20. But on the downside, you're never going to get less than 0. And you can't get that guarantee with the fund that you're speaking about.
So I'm really not receiving the return. Well, first of all, I'm certainly not receiving the dividend off the S&P. But now you're telling me maybe I'm not even actually participating directly with the S&P.
Right. But, you know, that's interesting that you bring up dividends, because that's a huge objection for a lot of people when dealing with index products. But what you have to realize is the insurance company is not directly investing in the index. The funds are still held in a general account, which protects the policyholder from losses. But by not directly investing in the index, the insurance company doesn't receive the benefit of the dividends. That's why they can't pass them on to the policyholders. You also have to keep in mind, though, by not participating directly in the index, you're protected by that floor of 0, regardless of what happens to the market.
Well, I remember in the day, about a decade ago, when indexing started to become somewhat popular, we were told we will never see double-digit returns. There'll be a cap. We'll never see a cap of above 9, whatever it was. We'll never see 100% participation. We'll never see not only some floor guarantees, but you just named a big one, 3%.
Right.
I mean, that is huge. I'm wondering, because we know, like, as an example, Allianz has the leading cap rate of 17%. Who's a player at the 3% floor?
Well, Midland National Life has a 3% floor, but what you need to understand is with index products, the floors don't compare on apples to apples basis with a traditional UL. So with a traditional UL, let's say your current assumed credited rate is 4.5%, but your floor is 2% annually. Well, on an index life product, your current rate is, let's say, your 17% cap on your Allianz product. On that product, your floor is 0, but you're also going to have a secondary floor, which is effective in the event of death, maybe lapse or surrender, depends on the company, but it's a secondary guarantee on top of that 0% floor. So the 3% floor that I alluded to with Midland National Life is not an annual floor. It actually is credited in the event of death, surrender, or lapse, if I recall accurately. But it's not credited every year. The reason the insurance company does that is by not truing up that guarantee every year, gives them a little bit extra money to spend on options, which are the vehicle that we use for the index-linked interest.
So if I just heard you right, and I want to make sure everybody's hearing this right, well, then really we're not getting a guaranteed 3% on the money that we put in this policy.
Correct.
All right. Now, I know some of them do actually credit, I guess that's the better word, credit 8%. Are they really crediting 1% then, or are they doing this only on the death benefit? Are you actually getting 1% for sure?
It depends on the company. And most companies have a guaranteed annual floor on their fixed bucket that's just like a traditional fixed UL. So what our agents are already familiar with. But most companies on the indexed portion, if I choose to allocate monies to the S&P 500 on an annual point-to-point crediting chassis, the floor is going to be 0. And then they'll give that secondary guarantee if the client dies or surrenders
Well,
the
no,
contract.
I'm thinking of one example of this would be Pac Life. I notice they have a point, and when I use it on an illustration, it seems to mitigate the expenses of the policy. It seems to be direct. Am I misreading that?
Can you clarify?
Yeah, like I noticed that when they credit up a 1% floor rate, and I'm looking at my total expenses, it seems like that 1% is kind of picking up some of that cost. Or am I misreading that?
No, you're correct on Pac Life. And Pac Life is a little different in that they have a choice of crediting methods. And on one, they offer a floor of 1%, and on the other, they offer a floor of 0. You're talking about the 5-year term endpoint strategy, if I recall.
Yeah, the one thing I like about that, and I don't know if we can actually go to this, I'm kind of wondering, is it possible in the bigger picture, someday we'll be able to say, hey, we're going to try to give you at least enough to pick up the expense loads of the policy. I mean, that 5 year, although that 5 years is a long time to rate, and I guess if it was a sideways market, maybe that's the way to go. But that's a long time to wait for your rate of return 60 months out.
Right.
But if I knew that 1% of maybe 2.5%, 3% total expense all in was being picked up, that's going to help some of that. So
right.
I'm wondering maybe the next evolution of product is, hey, we are going to give you just enough floor to take care of the expense loads and whatever the cap is.
Well, I'll tell you, that's an interesting idea, and product innovation is constantly changing, but
Wait a minute,
I don't
did
think
I just
we'll
make
see
that
that.
up? Did I just make that up? Because I want copyrights on that.
No, I don't think that's going to happen
Okay.
anytime soon, though, Steve.
All right.
Because the interest rate environment is so low right now. And remember that anytime you're offering an index product, in order to offer more potential for upside, it has to come from the downside. So if I have a richer guarantee, i.e. a higher floor, that means the potential for index gains is going to be lower. My cap's going to be lower. And so by increasing that guarantee in this environment, you're basically writing yourself out of the market because your caps aren't going to be competitive to competitors.
Yeah, I'm thinking about, how many, when I look at all the index, you have how many carriers are on life specs?
39 companies offer index life, and we have all of them on life
All right,
specs.
so if I have 39 companies, but then each company might have 1, 2, 3, 4 products.
Yeah.
And it could be single life or second to die.
Yeah, and we even have some single premium products.
So when you look at all the products that your software package due diligence carries, what's the all-in product? How many products do you think are on there after 39 carriers?
Oh, a couple hundred.
Wow.
And the neat thing is we keep the product information on there for products that aren't available for sale anymore. So,
I noticed that, yeah, because like you already sold this, you have business in force. You're trying to remember, what was the policy provisions on that? What was the specs on that? And you can go out to Life Specs, Sheryl's product, and you can look at that and say, oh, it's not available, but I can still look at the numbers.
yeah, we don't track the changes to the rates or anything after the product's not available for new sales, but we found that that's really handy for anybody that maybe takes over orphan policyholder or maybe gets into a replacement situation. Well, it's not like you can just call that insurance company and say, what was this? At least
that's
this
not gonna
provides a
happen.
nice framework. So you can see, what was this product that they were sold and how can I compare it to maybe what I'm offering now?
Well, I really like that because I can at least go back into the past, figure out what I should do, and then order my in-force ledger appropriately.
Exactly.
Well, in the next segment, we're going to talk more about Sheryl's product, but more than that, I want to get into some of the specifics on the policy provisions because it's things that we think you should know when you're thinking about purchasing, whether it's for indemnification or whether it's from income. It's very important to kind of know what provisions and how they play and the actual definitions. You're listening to the Business Insurance Zone. You can watch us at www.brokersalliance.com. When we come back, we'll have more with Sheryl Moore and find out what it's all about to do indexing. Steve Savant here. For years, I've heard that less than 2% of all term life insurance ends in a claim. That's not many, and clients had to die to receive the benefits. That's the old term insurance. Now start selling term insurance. The term insurance that covers your client through a chronic illness, a catastrophic event, or a terminal diagnosis, and pays their monthly premium during extended periods of unemployment. What term life insurance can do all that? Western Reserve Alliance Advantage Term with living benefits. No other term insurance product bundles so many solutions to life's unexpected problems. And all in one policy. So for more information, call Brokers Alliance 1-800-290-7226. Stop selling the old term. Start selling the new. Back to the Business Insurance Zone, the talk show that features insurance in your practice. I'm Steve Savant, your host, financial color commentator, and interviewer extraordinaire. I'm with Sheryl Moore. Sheryl Moore's with Life Specs. She invented Life Specs and Life Annuity Specs. Actually, it's Life Specs and Annuity Specs. And we're talking about indexing on life right now. And we're just trying to set the stage, do some groundwork. We're doing a little spade work today because it's not only these provisions, but what they actually mean. Now, one thing you do that's a little different than some of the other due diligence software packages that I see is you actually don't get this from the carrier. You're actually pulling these numbers and all the policy provisions direct from the filing at the state level.
Yeah.
Talk a little bit about the difference and why that matters.
Well, I'll tell you, Steve, in my former life, I did competitive intelligence for a home office. And I found that there's so many
Wait a
different...
minute, I love that. Competitive intelligence. Like our competitive intelligence here at Brokers Alliance, we call it countermeasures.
Yep.
Sounds very stealthy.
I like to tell people I'm an insurance spy. Well, when I did competitive intelligence for the home office, I found that oftentimes I would use software where the software company would send a profile sheet to the company, ask them to fill it out. Well, it's very easy to, let's just say, make things look better than they are sometimes when that's the option.
Well, this is the no spin zone, okay?
Right,
So,
exactly. I didn't want any spin. So I said, well, I'm going to do things different. I'm going to look at the product and standardize the information and make it easy to understand and straightforward, good, bad, or indifferent. So I actually pull the information from the specimen contract, and then I work with the carrier and request their marketing materials and rate sheets. When I'm done with my product profile, I send it to the insurance company and say, here's what I think of your product. Do you consider this to be accurate? Now, once in a while, I'll get somebody who will push back and say, well, we prefer that you not communicate it that way. It sounds so negative in that way. You know, and I say, look, we're not here to help you market that feature. We're here to help agents understand appropriately how does this work.
That's why I love you.
Thank you.
I mean, Sheryl, this is why our producers want to know the unvarnished truth on these issues. And I really like it because this is laid out in a very, I love the chronology and everything else. Now, let's just talk about a few of the basics.
Okay.
I'm looking at this. Generally, the 90% of my questions in index is what's the cap, what's the par rate, any floor issues, right? So talk a little bit about cap and how it relates back to participation, because those kind of can work in tandem.
Okay, well, I'm also going to bring a third thing into the conversation, which is kind of new, and that's a spread. On index insurance products, whether you're talking index life or index annuities, we must limit the interest that is credited to the policy. If we didn't limit the interest, we couldn't afford to provide a floor in the event that the market had a downturn. We don't want the client to experience negative adjustments to their cash value. So there are three ways to limit the indexed interest on an indexed insurance contract. One is through a participation rate, two is through a cap, and three is through a spread. Now, traditionally in the index life market, not many carriers have used the spread. We do have two companies right now that use a spread, and it's going to become more popular being that this is a low interest rate environment. Typically, people are looking at a participation rate and a cap, though. This is what is my moving part, what is my way of limiting the indexed interest, okay? Caps are the most predominant measure of limiting the indexed interest. If the index life product offers a cap of 17% and the market goes up 20% over a 1 year period, the client receives a interest credit of 17%. The difference is 3%, it's a wash because the insurance company bought an option for a cap of 17. It's not like the insurance company keeps the difference between the 20 and the 17. Okay? If the market were to go up 15% and our cap is 17, the client receives 15%. Okay? Participation rate is a little different because it says we're not going to limit the amount of indexed interest if it goes up 20% with that 17% limit. We're going to give you X percent of any growth the market does. So let's say our participation rate is 50% and the market goes up 10%. Well, the client's going to receive a credit of 5%.
But that's it.
That's it.
So do you find, I mean, because these are all supposed to be long haul instruments. I mean, if you're buying life insurance, especially for accumulation, this should be looked at as a timeline,
Absolutely.
probably no less than 12 to 15 years.
Right.
So if I'm looking at a timeline at minimum 12 to 15 years, I'm just trying to think about a par rate that's going to slice my cap in half. Doesn't really sound that appealing.
Well, you know, the interesting thing is, and I didn't give you an apples to apples comparison, but some people have been trained in terms of indexing that, you know, participation rate's always better because I'm not limiting my client's growth. What everybody needs to understand is that it doesn't matter if I'm limiting the gains through a cap or through a participation rate or a spread, or whether I'm looking at index interest based on the S&P 500 or the Dow, or using monthly averaging or annual point to point. These products are going to outperform fixed UL by 1 to 2% over the life of the contract. I don't care what crediting method, what index, what way of limiting the interest you're using. And if you think about it from a, you know, logical standpoint, options are what we use to provide the index linked interest on these products. How long have options existed?
Like forever.
Longer than index life
Right,
insurance.
right.
Index life has only existed since 1997. So the guy who's selling the options, he's the one who's going to carry the risk. Okay, so if he gives the client a cap of 17% and the market goes up 20, he's paying out 17. Don't you think that guy knows his stuff?
Oh, yeah.
And if there were a cap rate that performed better than a par rate, don't you think he'd price that a little bit more prohibitively? Or if the S&P 500 outperformed the Russell 2000, don't you think he'd be pricing that more prohibitively? He knows what his risk is. And let's face it, sometimes they don't see the future in their crystal ball, Steve. Home runs do happen, but these products are intended to return 1% to 2% greater than fixed UL that's being issued today over the life of the contract.
Now, when you talk about options, and of course, a lot of people are not familiar with options, maybe about half my audience is not even FINRA registered rep. So when I think about options, I think of, danger zone and major risk. And every 30 days, I'm sitting there, and the third week of the month, I'm dying a death or being very happy. When I see it how these caps and spreads are they there to try to mitigate this kind of exposure? Because if I don't credit anything, I think that's great, but aren't they on the hook still?
Well, no, the option expires. If the market goes down and we have purchased a cap of 17%, the option simply expires. The insurance company is investing the client's premiums, net of any loads, into the general account. That way they can ensure that there's no risk to the policyholders. And generally, the insurance company is going to be investing in long-term, high-quality bonds in order to make sure that they can make good on the
Yeah, in fact,
guarantees.
actually, talk a little bit about that, because I think that's a misnomer. Are we fully invested in an indice? Answer: no.
No.
So what are we buying here?
Well, that's interesting. Let's provide a comparison. On a fixed traditional UL, what the insurance company is doing is taking the consumer's premium and buying bonds. Let's say bonds are paying 4.5%. We're going to credit maybe 3.5% to the UL, and the difference is our spread, our profit as an insurance company, what we use to pay commissions, things like that. On an indexed UL, we take a similar scenario, but instead of taking 100% of our monies and putting them in bonds, what we're doing is taking 97% of the money and putting it in bonds, and the 3% that's left over, we're buying the options for the index-linked interest.
I want you to know, I think I'm going to get hammered on this one issue on email, because I think everybody thinks we have 100% of our money sitting in an S&P account or a Russell 2000 or a Hang Seng or Euro 50. And you're saying, no, the vast majority of it's still buying U.S. Treasuries, which after the debt talks, I don't know what to think about that. But it's buying U.S. Treasuries. They're very small options. They're trying to just give a little more edge than their normal crediting rate on their interest rate.
Exactly. And, my example is not to scale necessarily. Some companies might use 96%, 4%, or 98% too. But it's a very small portion of your budget that's being used to purchase the option that provides the index-linked interest. And some people say, well, yeah, but 17% cap, that's a lot higher than a 4.5% rate that we're crediting on traditional UL.
Well, you could hit a home run on a major option call too.
Exactly. But realistically, is the client going to earn 17% every year? No
Probably
way.
not.
No way.
But I like the part where they don't get dinged for it every year either.
Absolutely, and that's a nice thing about IUL.
Well, I'm thinking about, now that we're kind of getting a revelation here. I think a lot of our people are going to say, Steve, I just didn't know any of this. And I think that's one of the issues of we're selling a product that we don't know anything about. Okay, and that bothers me because I think we should know a little bit about it.
Right.
When we're talking about the things you're talking, the spread, the cap, and the par participation rate, those three in tandem, right, is the trifecta probably of this whole idea. We got to understand that. So when you're looking at this, what am I looking for? My producers are wanting to know, Sheryl, you're the authority in the United States on indexed products. What am I looking for in my cap, par, and spread so I can get the best possible show for my client?
Well, what you need to know is that most insurance companies choose to use only one of those three moving parts
At any one time.
At any one time. There are a couple of exceptions, but there's only two companies that use a spread on their index life, and that is the moving part for their index life. The other companies that use a participation rate or a cap, they typically are not using both, because if you use both, that translates to confusion. I mean, how do I calculate what the client's going to get if the cap is 10, but the participation rate is 90?
Right.
So most companies, if they use a cap, the participation rate is 100%. Likewise, if they're using a participation rate, there is no cap.
Well, what's 140%? What happens when you go above the par rate? Because I remember when I first heard somebody, the first time, this was back about a decade, the guy says, well, when they give 100, they credit 110%. And I was like, well, how can they do that?
Well, if you look at two like crediting methods, let's say we're looking at two different annual point-to-point crediting methods on two different products. This one offers a participation rate of 100% and a cap of 17. This guy might offer a participation rate of 110, but his cap might only be 15. That's pure marketing, Steve. And insurance companies have developed all these different crediting methods.
Well, you say that with such disdain.
Well, you know, I only say that with disdain because I'm frustrated that insurance agents are intimidated by these products. And the reason they're intimidated is because they think they're so complex. Really, they're not. They're quite simple in terms of life insurance, but some of the marketing has gotten in the way of telling that story.
So the spread, the par rate, they're just two different ways of picking off the return. And the spread, now you're saying its spread may be becoming more popular.
Well, and that's just because the interest rate environment is really miserable right now. Insurance companies are looking for a way to say, hey, look at me, sell my index life product. Mine's more attractive than so-and-so's. And with many people using caps, and we have them as high as 17% right now. Some companies have said, well, I need to start using a participation rate of greater than 100% in order to get guys' attention because I can't compete with the 17% cap. Well, now you've got these new guys who are saying, look, I can't compete with a 17% cap or 140% participation rate.
Well, one day I just took your S&P 500 and I said, I want to see everything that Sheryl's done throughout the entire index market on life. And I said, I just want to see the S&P 500.
Yep.
And then I said, I just want to see point to point. I was trying to make everything as equal as I could. Then I said, now, based on that, who's spread, who's doing the par rate, who's doing the cap rate.
Yep.
And to see who really is functionally giving me the better number if I like the S&P.
Well, what you need to understand, Steve, is that even if you go to lifespecs.com and look at our product rates so that it easily puts everything on an apples-to-apples basis for you, is that there's one thing that's not being shown on the website that your agents need to know about, and that is what is the integrity of the renewal rates for the insurance company you're doing business with? Because some of these insurance companies have very high inflated first-year rates, and they're subsidizing them with their rates in years 2+.
That sounds so evil to me.
No comment. I'll just say it's become a function of our independent agent distribution,
I
unfortunately.
understand. Well, Sheryl, I thank you for being on our show. We're going to have you on tomorrow because we're just going to keep talking about this. Is really hot. Remember, you can contact me at thebiz@brokersalliance.com. Hop out on our website, www.brokersalliance.com, or any of our Vimeo or YouTube sites. We carry all the shows. I'm Steve Savant. You've been listening to the Business Insurance Zone. Well, that's the buzz on the biz for today. Get in the zone, the Business Insurance Zone. This has been a Bravo video event of the National Insurance Clearinghouse and Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. You can contact Brokers Alliance at brokersalliance.com or 1-800-290-7226, extension 147.